Okay. So in yesterday's session, we went through all the important topics from section B. So today, we shall discuss about the important points from section C. Okay. So section C is about the performance management. Okay. So what are the performances that are happening in a company? We mainly speak about the activities that take place in a firm and how well do we manage them. That is what we look into in section C. Okay. So I hope my screen is visible for all of you. Yes. So in section C, we will be covering about standard costing and variances. What is standard costing and what are these variances and how do we correct them and why they are important for us. Then comes responsibility centers. Yesterday, we had a small discussion regarding responsibility centers. So today we'll learn them in a little more detail. Then comes transfer pricing. And later, we'll be learning about ROI and RI, which are our most important financial indicators. Then comes balance scorecard. That's a 360-degree evaluation of all the departments in an organization. So now, yeah. Yes, so these are the key topics that we are going to discuss today. Management by exception, which we call it as MBE, and standard costing, the variance analysis across all these activities, that is direct material, direct labor, mix and yield variances. Next up, we have the overhead variances and sales variance. So then responsibility centers and transfer pricing, followed by return on investment, residual income, and the accounting policy impacts on them. Later, we study about the balance scorecard and the profitability analysis. And later, we will walk through the quick reference for the important formulas. Okay. So now we shall start the discussion from management by exception and standard costing. Okay, guys. So in simple words, how do you define management by exception? What is meant by management by exception? Guys, what is meant by management by exception? It's a very simple term. Okay. So in the management by, okay, significant differences are investigated. Perfect. Good. So in management by exception, we talk about how top level managers view the variances and what variances are investigated by them. Okay. So management by exception, we are speaking about how top level managers are handling with the variances. So top level management, already they will be involved with lot of works related to strategy planning, budgeting, and overviewing the performance of the organization and so on. So they will be held up with most important activities of the organization. And they don't have much time left for investigating each and every variance of the organization. So what do? They just investigate the important variances. So what are these important variances? We call them as significant variances, which are causing maximum loss in the organization, which are causing maximum negative impact or unfavorable impact in the organization. Okay. So this is known as management by exception. So they will choose the significant variances and they will measure what are their impacts and they will look into correcting them. Okay. Then what about the rest of the variances? So that will be taken care by the lower level managers. Okay. Only significant variances will be taken care by the top level managers. Now, we define MBE as only significant variances between actual results and the budgeted plan are reported to top management. Joshna, can you please mute yourself? Okay. So now, management by exception, when we listen to this topic, we'll find it out very easy. We'll find it very beneficial because top level management, they're investigating only the significant variances and rest of their time they can allocate it for other important works of the firm. But MBE has both benefits and limitations. We'll look into the benefits first. So here, it focuses management attention on highest priority issues. So that's a good thing. Highest priority issues they can solve first. Rest of their time, they can save it for other important tasks. Then it is defined by greatest unfavorable variances. Unfavorable variances are nothing but the variance which are causing us more loss. Okay. And it is causing us more negative impacts. So that will be corrected first. Then it saves time because only problematic areas are escalated to the top level managers. The rest of the things are taken care by the lower level managers. Then what are the limitations? Negative trends may be overlooked at early stages. So any variance, when it starts to become an unfavorable variance, it starts by a smaller amount. And as in how the time periods pass, they will grow in number. Okay. So in their initial stages itself, if we locate the variances that are unfavorable and if we correct them, then we will not have to face negative impacts from them in future periods. But here, because we are choosing only significant variances, we will ignore these negative trends which are small in number. And in the future day, they may grow into significant unfavorable variances. So in initial stages, we are ignoring the unfavorable variances because of their insignificant amounts. Then small variances accumulating over time can be missed. So this is what. So when you ignore hundreds of small variances at a time, when you combine all these hundreds of small variances which we ignored together, that might become a significant variance for us. So accumulating all these small variances together, that will become a huge unfavorable variance for us. So this impact, they will neglect in MBE. Then favorable variances also deserve attention. Why? Because favorable variances are good positive impacts that we have created for the firm. If we learn how favorable variances have appeared in the organization, we can improvise them. That is one thing. And one more thing is we can follow the same measures in other departments as well, so that we get more and more favorable variances across different departments. So now there are equal benefits and limitations by MBE. So MBE focuses on greatest variances, which saves time for the management, but early warning signals from the negative trends, we will be ignoring that. That's the biggest limitation. Okay. So next up, how do we establish these standard costs? So in yesterday's class also, we discussed about the methods of fixing these standards. So what are these standards? So in the preparation of our master budget, we depend on the standard costs of direct material, direct labor, and manufacturing overhead. So where do we get these standard costs from? That is what we find out. That is what we estimate in our organization. And there are various methods for us which helps us estimate standard costs. Okay. And they are activity analysis, historical data, benchmarking, target costing, and Kaizen. Since we have discussed this already, I'll be asking you questions regarding this. Everybody open your chat box and you can start answering. Okay. So the first question is, among the 5 methods, which is the most accurate one, at the same time, the most time consuming one? Among the 5 methods of fixing standards, which method is the most accurate and the most time consuming? Activity analysis. Good. What about remaining students? Okay, guys. So the more interactive you guys are, the more you can take the benefit of these sessions, the more you can revise properly. Okay, perfect. It is activity analysis. So why it is more accurate in the sense, in activity analysis, we will be involving the efforts of product engineers, okay, and the purchase managers and the people who are actually involved in these activities, the professionals, and from them we will be taking the standards. That is why it is most accurate, and at the same time it will be time consuming because you will have to schedule meetings with all of them, and at the same time it is more time consuming, at the same time expensive as well. Okay, so that is about activity analysis. So the next question is, in which analysis you already have the ready standards and you just have to implement it? You already have the standards ready. You just have to implement it in the current period's budget. Which is the method? Perfect. It's historical data because you're not putting any efforts in establishing the standards. Standards are already present. We're just using them in the current scenarios. Perfect. So I'll give you one more numerical example. Okay. Company had fixed its standard direct material cost per unit as $10 in previous year. Okay. Direct material standard cost was $10 fixed in the previous year. This year, they have reduced the direct material standard to $8. This follows which method? Good. So that is Kaizen. It's continuous improvement. Perfect. So why it is continuous improvement? Because you are improvising yourself to reduce the cost of direct material from year to year. That's an improvement. Past year, the direct material cost was $10. This year, you're reducing it to $8. That means you're improvising your efficiency by reducing the cost. That is continuous improvement. Good, Sushmita. Everybody got this? Everybody understood this method? Yes. So I'll give you one more scenario. Now, there is a very competitive market, okay? And I don't have the liberty of fixing the price. I'm assuming the market price as the price for my products, okay? And then I want to earn 10% on the selling price as the profit. Now, which standard or which method do I use to determine the standards? Yes. Perfect. It is target costing. So in target costing, what happens? The market will be so competitive that I can't predict my market prices. I don't have the liberty in fixing market prices for my products. What do? I simply assume the market rates itself as the price. And I have a profit motive. I have to earn a certain percentage of profit on market prices. The remaining price that we are collecting will be cost. So this is how we determine the standard cost in target costing method. Okay. So then I have the number one is data. Number one company in our industry, I have their standard data. Okay. And I want to reach that standards, and I am assuming the standards of my competitor as my standards in the business. So which method are we using? Perfect. It is benchmarking. I'm comparing against the best performance in the industry and I'm assuming these standards. That's benchmarking. Perfect. Then we also studied about denominator level capacity concepts. Okay. So we have two supply side concepts and two demand side concepts. In supply side, we have theoretical capacity, practical capacity, and in the demand side, we have master budget capacity and normal capacity. Okay, let me ask you questions now. According to US GAAP, which is the best concept to choose for determining manufacturing overhead standards? According to US GAAP, which is the acceptable concept? Perfect. Very good. It's normal capacity. Okay. Now, in the organization's perspective, which is the best concept? Which is the best concept according to organization's perspective? Master budget. Yes. So why is it master budget? Because master budget capacity, we are determining it based on our estimate of the next year's sales forecast. Whatever units we estimate to be demanded in the coming year, the same thing we are using for determining the capacity level. Okay, so that will be most practical for us because we know most probably what will be our sales forecast and what will be our expenses forecast for the coming year. We know it exactly. And based on that, we are fixing the capacity level. So that is why, according to organization's perspective, master budget capacity suits best. Okay. Then, which capacity level is the best for fixing the prices of the product? When you want to fix the price of the product, which concept do you choose? Which is the best one? Think carefully. When you want to determine the price of the products, which capacity level will be the best one for you? Okay, it's very simple. It's practical capacity. Why is it practical capacity? Because in practical capacity, that is giving us the maximum capacity of units that we can produce by eliminating the idle time. Okay, so now when you eliminate the idle time in 24 hours, if you eliminate the idle time for, let us say, 14 hours, you have eliminated. Okay, remaining 10 hours is a very productive time for production if you use it carefully. So that is exactly the amount of products that we can produce. Understood? So if you use the practical capacity for pricing the products, that is the best capacity level. Why? Because it is practically stating if you use your time very productively, how many units you can produce using that particular point of time. So based on that, if you allocate the costs, you can eliminate this overpricing. Okay, overpricing will not be there. Exactly what price that you can allocate, especially for fixed manufacturing overheads, that will be properly allocated in practical capacity. Okay, always remember, when you need to price the products, if you overprice your products, you will lose customers. If you underprice the products, you will lose profits. You have to price it exactly what it is. So for that, you should know how many units you can produce in the given point of in the given period of time. If you best utilize it, what is the maximum units you are able to produce? That is how you have to price the products. Okay, not based on the average units that you have produced, which is spoken in the normal capacity, not based on what is your sales forecast for the coming year, not based on that, and not at all based on theoretical capacity, because it is practically not possible at all. So what is the maximum capacity that you can produce? It is spoken in practical capacity. That is why you use that. Okay. Understood about practical capacity, all of you? Any doubts? Okay, guys. Then comes theoretical capacity. We know this. So theoretical capacity, it just remains in theory. Okay. So we are practically not able to achieve this because it specifies that 24 hours a day, if somebody works, what is the capacity level they are able to reach? That is theoretical capacity. Okay. So these are the standards and concepts that we use in establishing the standard costs. So the methods for fixing standards will be used for fixing the standards for direct material and direct labor. Okay. And denominator level concepts you will be using for determining your manufacturing overhead values per unit, manufacturing overhead rate per unit. Okay. So next, we are moving into variance analysis. So in the first step, what is this variance? Variance is nothing but whatever the value that we expected to incur in the organization and how it is different from the actual. Suppose in the coming year, 2027, according to all my external and internal analysis, I have determined that my expected sales revenue in the coming year can be up to 1 million. That is my expectation in the year 2026. Now, when I get the actual data of 2027, so there are two possibilities. It can be any amount. There are three possibilities actually. It can be any amount lesser than my estimate, which is 1 million. It can be exactly equal to my estimate, which is 1 million, or it can be greater than my estimate of 1 million. Okay. This entire variance analysis, we will be using this in order to find out in what ways we are earning the favorable variance. Okay. Favorable variance in the sense, I have estimated 1 million of revenue, but I have earned more than 1 million of revenue. That will be favorable to me. Okay. And what are the unfavorable variances? Suppose I estimated for 1 million, but ended up earning less than 1 million, 800,000, 700,000. So that is a unfavorable variance for me. Okay. So in this variance analysis, what I will focus on is favorable variances are very good for me. They are my assets, a kind of assets. They are my benefits. Okay. I will focus on improving my favorable variances. Okay. When it comes to unfavorable variances, that is the area where we need to focus on reducing the losses. So this entire concept of variance analysis is about identifying all sorts of variances that we have got, significant variances. And guys, always remember, only significant variances we will be investigating. So now what is this significant variance? A simple example. Today, if I lose 1 rupee somewhere, I don't worry about it so much. Suppose I lose 10,000 rupees today, I will be worrying on that. That is my significant level. That is 10,000 rupees was significant to me. 1 rupee was not so significant to me. So only significant variances, huge amount of variances, both favorable and unfavorable, we shall be investigating. Okay. So there are 3 levels of variances. So first up, we have the static budget variance. And in the level 2, we will break down this static budget variance into flexible budget and sales volume variance. And in the level 3, we will further break down these flexible budget variance and sales volume variances into manufacturing input variances, sales quantity variances, and sales mix variances. Okay. So now let us understand what are these levels of variances. Okay. So on the level 1, we have static budget variance. It's a very simplest variance that we can calculate. It is nothing but we have prepared our master budget. So static budget is another name we give for master budget. Okay. So static budget variance in the sense whatever data we forecasted on master budget, if it is different from actual results that we got, that is static budget variance. Okay. So actual results versus the static or master budget variance is what we calculated static budget variance. Okay. So here it just says us the level 1 variance will just say us what was my expectation in sales revenue. Let us take for example sales revenue. What was my expected sales revenue? Assume it to be 1 million itself. Okay. And what is the actual sales revenue I earned? So let us assume it to be 800,000. My expectation was 1 million, but I ended up earning 800,000. Okay. Now there is the sales revenue I actually got is very less than what I estimated. So I will just come to know what is the variance. $200,000 sales revenue is less than what I wanted. That is what I find in static budget variance. But I'm not satisfied. I just came to know that 200,000 I have got less sales revenue. But where did I lose this revenue? How did I lose this revenue? I'll not get that information in static budget variance. For that, I will have to conduct level 2 variance analysis, which is flexible budget variance and sales volume variance. Okay. Now, there is a major distinction between this flexible budget variance and sales volume variance. We'll take an example. So sales revenue I am estimating is 1 million, but actually I got the sales revenue as dollar, or we can take it as 0.8 million. Okay. So now variance I calculated using the level 1 variance. I came to know 0.2 million variance, million sales revenue. I have lost it. It's less. Now, what is the reason for this? That we will find out in flexible budget variance and sales volume variance. Okay. Now there can be two possibilities here. Okay. Whenever we estimate our sales revenue, we will estimate how many units we can sell. We will assume it to be 1,000 units. Okay. And selling price, we will assume it to be 10K, 10,000. Okay. Now, actually, if we have, there can be two possibilities why we have got less revenue. We could have sold 800 units at the same selling price of 10K. Or there are other possibilities. I could have sold 1,000 units itself, but at a selling price of 8,000. Okay. Both of them are possible. If you calculate both of them, you will be getting 10,000 into 800. You will get it as 8 million. 800,000. We'll take it as 1K. Yeah. Yeah, now it will be proper. Okay. Yes. So both the cases when you calculate, you will be getting your sales revenue as 800,000 itself. But we don't know exactly what was the reason for this sales decline. So that we will find out in flexible budget variance and sales volume variance. Okay. In flexible budget variance, if the reason was the difference in your selling price, this one you will calculate in flexible budget variance. Okay. So what is flexible budget? Flexible budget is nothing but we are adjusting our actual units sold, which is 800. We are adjusting this with our actual selling price. That is how we calculate flexible budget, adjusting the standards for the actual units sold. Okay. Now we should have technically got a sales revenue equal to 800,000. Okay. Now as we have got 800,000, now the variance is not due to change in the selling price. So that will be very much clear in flexible budget variance. Okay. Now, what is the second cause which might have caused us the variance? It is change in units. So here we spoke about change in units. This can be a reason, or else change in selling price. This can be a reason as well. We have to find out what is the exact reason. Okay. Now what do we do? Here in sales volume variances, you will find out 1000 units you were supposed to sell, but you have sold only 800 units. 200 units you didn't sell. Okay. So now the variance will be 2 million, 0.2 million. Okay. So the two reasons why our variance will be caused is either you have not sold the units you expected to sell, or you have not sold the units at the selling price what you expected it to be. These are the two reasons. So in flexible budget variance, you will be finding out the reason if it is due to the change in selling price. Okay. And in the sales volume variance, you will find out the reason if it was caused due to the change in units. Okay. That is why we will split our static budget variance into flexible budget variance and sales volume variance. Okay. So this is a very simple concept itself. So now when you are very much aware whether it's a flexible budget variance, which is the variance caused due to change in our selling price. Okay. Or if it is a sales volume variance, which is the variance caused due to change in the units sold. Now we are interested to know what is the further variance that has been created. Why was there a change in the selling price, or why was there a change in the unit sold? We still want to dig deep. At that point of time, we will be moving on with the level 3 variances, which is manufacturing input variances. Here exactly we will come to know the cause why our sales revenue was less. What was the reason? Was it direct material? Was it direct labor? Or was it manufacturing overhead? What was the exact reason? We will come to know in level 3 variances. Okay. Now, when it comes to the detailing, level 1 variances, we will not get to know anything apart from what was the variance. In level 2, we will come to know what was the cause of this variance. And in level 3, we will come to know exactly where the variance was caused. Okay. Yes. Now we will move on into variance calculations. First up, we will be calculating the manufacturing input variances. Okay. So first up, we have direct material variance. So direct material variance has two types of variance, subtypes of variance. It is direct material price variance or direct material quantity variance. Okay. Always fix this in your mind, guys. If a variance is causing, it will be either due to change in price or due to change in units. That is all how a variance can occur. Okay. Now, direct material price variance. How do we calculate this? Actual price minus standard price into actual quantity used. That is how we calculate direct material price variance. Then, direct material quantity variance. It is actual quantity used minus standard quantity allowed for actual units multiplied with standard price. Okay, so let us understand the meaning of them. Direct material price variance. That means, suppose you had estimated a standard cost for the direct material at 10 rupees. If your actual price is more than 10 rupees, that's a variance. That's an unfavorable variance for us. Okay. Actual price minus standard price into actual quantity used. Okay. Yes. So now we will understand what is unfavorable and favorable variance. I'll give you the examples. You will have to find out which is unfavorable variance and which is favorable variance. So we know that we calculate the price variance using this formula. Actual price minus standard price into actual quantity used. Okay. So first scenario, your actual price is $12 minus the the standard price that we had allowed for the purchase is $10 multiplied with actual quantity of 1000 units. The second scenario, you have spent only $8 in purchasing, while the standard price that we allowed for direct material purchase is $10. And you have purchased 1000 units again. So now tell me which scenario, 1 or 2, is unfavorable. Which is unfavorable among the two? Perfect. So first one is unfavorable. Why? Actually, we have spent more than what was the standard allowed for. Perfect. Very good. That means the first scenario is unfavorable. And in the second scenario, I have actually spent less than what was the standard allowed. So that is a favorable variance for us. Okay. Okay, guys. Now, one more thing that you will have to focus here is MPPV, that is material purchase price variance. So before we discuss, can anybody tell me what is the difference between material purchase price variance and the normal material price variance? What is the difference? You can unmute and answer. What is the difference between material purchase price variance and material price variance? Okay, guys. Or else I'll give you a scenario. You guys calculate material purchase price variance and material price variance and tell me the answer. Okay. And you guys will have only 1 minute for solving it because it's a very simple scenario. So you can assume actual price to be $10, your standard price to be $12. Okay. And you actually purchased 1000 units. You used in the production 800 units. Okay, I'll give you only 1 minute. I want all of you to calculate MPPV and MPV. Material purchase price variance and material price variance. Perfect. So material purchase price variance is 2000 favorable and material price variance is 1600 favorable. Very good. So that is the difference between material purchase price variance and material price variance. So be clear, in MPPV, you will be considering whatever unit you have purchased, not what you just used. Okay. And in the material price variance, you will be including whatever you have used, not what you purchased. That is the major distinction. So your answer will be 10 minus 12 multiplied with 2000 for calculating MPPV. That gives you favorable 2000 because your actual price is less than standard price. Here it will be 10 minus 12 multiplied with 800. Got it? As simple as that. Okay. Now moving on with the direct material quantity variance. Okay. So direct material quantity variances, you will have estimated to use some units of raw material, but you will have used a different set of raw materials altogether. At that point of that time, based on the quantity allowed for the actual production and what quantity we used for actual production, we will be calculating direct material quantity variance. Okay. So this is also very simple. If the quantity allowed is 1000 kg, let us assume, and if the quantity actually you have used is 1000 kg and the standard quantity allowed is 800 kgs, standard price becoming the same value, standard price will take it as 10. Okay. This leads to unfavorable quantity variance because you have used more units than what was allowed. So here you will be getting an unfavorable direct material quantity variance of 200 into 10, which is 2000. Suppose you have used less quantity than what was allowed, then you will be getting a favorable variance. Okay. So these two variances combined, you will be getting your direct material total variance. Okay. This formula is also important. Direct material total variance will be equal to your material price variance plus material usage variance or material quantity variance. Okay. Suppose you have got a favorable price variance of 1000 and unfavorable material quantity variance of 2000, your total material variance will be equal to negative 1000. That is 1000 unfavorable. Okay. This is how we calculate variances for direct material. Okay. So next up, direct labor total variance. Same formulas and the same distinctions. Here in direct labor, we will have two subcategories, that is labor rate variance and labor efficiency variance. Labor rate variance means what was the wages I wanted to pay for the laborers according to standard and what price did I end up paying. So the difference between the standard wages that we wanted to pay for the laborers per hour and what is the actual rate that I've paid to them in 1 hour work. Okay, the difference between the wages paid, that we will be calculating in rate variance. So the formula is simple, actual rate minus standard rate into actual hours worked. Then moving on with the labor efficiency variance. In efficiency variance, actual hours worked minus standard hours allowed for the work multiplied with standard rate. Suppose the actual hours worked by the laborers is more than the standard hours allowed. That again leads to unfavorable variance. Okay. So now we will look into what are the causes of favorable and unfavorable labor variances. So this will be important for you if they have asked you a scenario based question. Okay. So let us first look into the causes of unfavorable variances. So when do we incur this unfavorable labor variance? So there are two chances. If the actual rate that we are paying for the laborers is more than the standard rate, it will lead to unfavorable variance. Suppose the actual hours worked by the laborers is greater than the standard hours allowed, again that will lead to unfavorable variance. Okay, these are the only two scenarios where we get unfavorable variances, when actual rate and actual hours is more than the standard allowed, as simple as that. Now, what is the cause for this? The causes will be, we might have hired inexperienced or inadequately trained employees. So if you have hired inexperienced people, obviously they will take more hours in production of the product. And the more the hours they consume, the larger will be the rate that we need to pay them. The larger will be the wages that we need to pay them because they have worked for more hours than allowed. Okay. Then poor material quality. What if the direct materials that we are giving for our laborers is of an inferior quality? Again, they will have to work more for segregating this material quality, and then they will have to proceed with the actual production. Again, that will involve some extra time in production. Okay, so that will lead to unfavorable variance. Then machine breakdowns or inefficiencies, again, that will waste a lot of time. These are the main causes for unfavorable variances. If you hire inexperienced people, obviously they'll waste time in production. And if you have bought poor material quality, direct material quality is very inferior. Even at that time, unfavorable variance is caused. And the next cause is machine breakdowns. Now, what are the favorable causes? Suppose you have hired skilled workers. Okay, so these skilled workers, they will take very less time and they'll do the work properly. Okay, so worker performance will exceed the standard allowed. That leads to favorable variance. Then more skilled laborer is used than planned. You have hired very skilled laborers. Obviously, they will perform well. Then better equipment or process improvements. So you have drastically reduced this machine breakdowns or inefficiencies. That will again improvise our production processes. Okay, so these are some of the favorable and unfavorable causes of direct labor variance. Okay, so now let me ask you all a question. So you will have to answer me which variance among labor rate variance and labor efficiency variance is going to be favorable in this situation and which is going to be unfavorable in this situation. Okay, situation is very simple. You have hired highly skilled laborers for production process. Now tell me which variance will be favorable and which variance will be unfavorable. When you hire highly skilled workers for production process, which variance is favorable and which variance is unfavorable? Guys, what is the answer? It's very simple. So labor efficiency variance will be favorable. Labor rate variance is unfavorable. Perfect. Very good. Yes. So efficiency variance is favorable and rate variance is unfavorable because they are skilled laborers. They'll take less time and produce the products. But as they are more skilled, you will have to pay them more. That is why rate variance will be unfavorable for us. Perfect. Okay. So the next variance calculation is about mix variance and yield variance. So when do we incur this mix variance and yield variance? So this multiple input variances will be caused only when we are using more than one sort of direct material and more than one class of labor in production process. So let me give you a small example. So we will take the example of coffee manufacturing industry. Okay, so they will not use only one direct material. They will be using many raw materials such as cocoa and chicory they'll be using. So whenever you are using more than one type of direct material in the production process or more than one class of direct labor in production process, you will have to calculate mix variance and yield variance. So what is this mix and yield variance? Now, in the coffee example, we have two direct materials. So cocoa and chicory. Okay. So according to your standards, there will be certain percentage allocation. Let us say cocoa you need to use 70% and chicory you need to use 30%. This is your standard that you have fixed. Okay. Now, when the actual production takes place, there may be fluctuations. You might have used 45% of chicory and remaining 55% of cocoa. So this variation might have happened. That will cause the price and quantity variances. Okay. And how do we locate them? It is through mix variance and yield variance. So we will focus on mix variance first. Portion of quantity variance that is caused by using a different input mix than standard. Input mix in the sense, the two or more direct materials that we are using, it should be in a specific proportion, specific percentage. If you vary that, and again your price that you are paying for direct material will vary. And the quantity that you have used for the final product, again that will also vary. There are chances. Okay. So in mix variance, what do we calculate? So what was the increase or decrease in the direct material price that was caused for this fluctuation? Direct material price changes we will be locating in mix variance. Okay. So now, when you use more of one ingredient and less of another ingredient, we'll take the same example, chicory and cocoa. So let us assume chicory's price is somewhere around 120, cocoa's price is somewhere around 100. So you have used more chicory than necessary. Okay. And you have used less cocoa than required. Now what happens? You have used the costliest raw material more than what was required and the least cost raw material less than what it was requiring. Obviously, your mix variance will be unfavorable. Got it? So, the changes, the variance that is caused due to different inputs than what was required, the price changes that happens, that you will be calculating in mix variance. Okay, how do we calculate? Again, it is by using this formula. Mix variance is equal to VASP AM minus VASP SM into AQ. So what is this VASP AM? It is nothing but weighted average standard price for actual mix minus weighted average standard price for standard mix multiplied with actual quantity. Okay, so now how do you calculate this? So you will have your budget that is present for standard mix, whatever standard that you are supposed to use. And actually, what was the quantity of direct material you have used, the data you will be having. Okay. Based on that, you will have to calculate your VASP AM and VASP SM and calculate your mix variance. Okay. So now, our next type of variance will be yield variance. So what happens in yield variance? So price changes we located in mix variance. We have to locate for quantity variances, right? Quantity changes. This quantity changes we will be locating in yield variance. So yield variance results from difference between actual total inputs versus standard inputs for actual output. So let me give you one more example. Here again, the chicory you should have used, let us say, somewhere around 10 kgs. And cocoa, you should have used somewhere around 5 kgs. But your actual data that you are using, let us say you are using 15 kgs. And here for cocoa, you are using 10 kgs. Okay. Now add them together. Actually, you should have finished it within 10 plus 5, 15 kgs. You're using 25 kgs. Okay. More quantity of direct materials you're using. Actually, within 15 kgs you should have completed. But actually you have used 25 kgs. So will it lead to favorable yield variance or unfavorable yield variance? We can type in F for favorable, UF for unfavorable. It's unfavorable. Your usage is greater than what you wanted to use. Perfect. Okay. So these variances for multiple inputs we will be calculating. Okay. So here you need to know about VASP-AM and VASP-SM calculations. So these calculations are very simple. So for calculating weighted average standard price of actual mix, what you are supposed to do? You will be calculating standard price of each input multiplied with actual quantity that you have used. Okay. Then for finding out VASP-SM, standard price of each input multiplied with standard quantity that was allowed. Okay. When you calculate for each input, you will be adding them together. That is how you calculate VASP-AM and VASP-SM. Okay. And actual quantity, it is very simple. Here only we calculated. Actual quantity used was 15 plus 10, 25. Standard quantity allowed will be 10 plus 5, 15. So calculations you should be very clear about. And let me tell you one more thing. In this in this multiple input variances, sometimes they will ask you to find out direct material variance and direct labor variance. Okay. At this point of time, how you have to calculate? You should not add them together. You should not add all the values together and calculate. You should calculate the material variance separately for each of them. For chicory, separate calculation. Okay. Same formula. Formula will remain the same, but you are not supposed to add or aggregate the values together and calculate. You should calculate them separately. Okay. So everybody is clear with mix variance and yield variance, how you have to calculate them. If you have any confusions in calculation of any values, I didn't cover them in detail because I just wrapped it around. So if you have any confusions, you can ask me. I'll clarify that to you. Okay. What about the remaining students? If you feel any confusions, you can clarify. Okay. So next up, we have the calculations of overhead and sales variances. Okay. So we have two types of overhead. What are they? Variable overheads and fixed overheads. Okay. So for both variable and fixed overheads, we will be analyzing how did these overhead variances occur and how do we locate them. We will be calculating it. Then next up, the same calculations with sales variances. So first up, we will cover our overhead calculations. Yes. So in our overhead calculations, first we are looking into variable overhead variances. Okay. How do we calculate variable overhead variance? So here there are two segregations, variable overhead spending variance plus variable overhead efficiency variance, two types of variances. Now, how do we calculate them? So the formula for calculation is very simple. It is very simple like our price variance and quantity variance. So it is actual price minus standard price into actual quantity for spending variance and actual quantity minus standard quantity into selling price for efficiency variance. Okay, so now what are these values? Actual price is nothing but what is the actual variable overhead per unit that you incurred minus what was the standard variable overhead allowed per unit multiplied with actual quantity produced. Okay, here actual quantity produced minus, so standard quantity that you were allowed to produce, that standard quantity of hours that you were supposed to use multiplied with the standard variable overhead per unit. Okay, so here it is nothing but variable overhead actually incurred per unit minus variable overhead allowed for the standard multiplied with actual hours that we have consumed. So one thing we have to be clear in allocating the overheads is we will allocate it either based on our direct labor hours or direct machine hours. Okay. So in this actual quantity, you will be actual quantity and the standard quantity, you will be considering direct labor hours that was allowed for actual production. Okay. And the standard quantity will be standard direct labor hours that was allowed for actual production. Okay. So now, what is this variable overhead spending variance? So in simple words, what is the actual variable overhead that we incurred minus the standard variable overhead allowed for actual production? That is how we calculate. Then, if it is unfavorable, why unfavorable variances will be caused? Because there will be an increase in the cost of variable indirect materials or increase in the cost of indirect labor wage rates. So here overhead is nothing but indirect cost. Okay. So if there is any increase in variable indirect materials or indirect labor rates, that causes us unfavorable variances. An exact opposite of that will be our favorable variances. Decrease in the indirect material cost, more energy efficient equipments that will reduce our costs. One thing that you have to remember is when you calculate variable overhead efficiency variance, overheads we are allocating based on labor hours or machine hours. Okay. Suppose you have used direct labor hours more than that was needed. So in one word, if I have to say, your labor efficiency variance or labor usage variance, that is unfavorable. Okay. When your labor efficiency variance itself is unfavorable, automatically your variable overhead efficiency variance will also be unfavorable. Okay. So why it is so? Because look at this one. Actual quantity, your actual hours that you have used, if it is more than standard hours allowed, obviously your variable overhead efficiency variance will also be unfavorable. Okay. So whenever you find labor efficiency variance unfavorable, your variable overhead efficiency variance will also be unfavorable. Okay. So now, why variable overhead efficiency variance will be caused? It is caused by different usage of allocation base than expected, different usage of direct labor hours than we expected. Then actual quantity will be equal to actual hours, SQ equals to standard hours allowed for actual output. Then efficiency variance measures how well the allocation base was used. How well you have utilized your direct labor hours. That is what we measure in efficiency variance. Okay, so for all these variance calculations, you should solve as many MCQs as possible. Okay, only then you will get a clarity on how you can solve. So next up, we have fixed overhead spending variance. So what happens in fixed overhead spending variance? So here, the total fixed overhead variance is of two types. fixed overhead spending and PV variance. Okay. So spending variance is a difference between our actual fixed overhead minus our budgeted fixed overhead. Okay. So let me give you an example. Let us assume we have rented a factory. Okay. Now the standard rent that I have estimated is 10,000. And due to various factors such as water bills or current bills or something of that sort, the owner is asking me to pay 12,000. So actual fixed overhead I'm spending for this factory is how much? 12,000. But budgeted, I had budgeted it to be only 10,000. Okay. So now when your actual fixed overhead is different from your budgeted fixed overhead, that is called as spending variance. Okay. Either it can be favorable or unfavorable. We know how it is favorable or unfavorable. When your actual is greater than budgeted, it will be unfavorable. When your actual is lesser than the budgeted fixed overhead, it will be favorable. Okay, as simple as that. Now, moving on with one more overhead calculation, which is fixed overhead PV variance. What things we have to remember in the second type of variance is, here we are speaking about the capacity utilization. So what is meant by this capacity utilization? We'll first understand this example. Okay. Now, assume that you have a manufacturing equipment. Okay. And in that manufacturing equipment, you can produce somewhere around 1,000 units. So, but what happened? You have produced only 600 units. Actual capacity is 1,000 units. But in reality, we have produced only 600 units. So what does that mean? Only 60% of the capacity utilization took place. Remaining 40% capacity we didn't use at all. Okay. So now in this production volume variance, it is purely calculated to measure whether we are completely utilizing what capacity we have or we are underutilizing it. For this purpose, we use PV variance. Okay. Now, how do you calculate that? Budgeted fixed overhead, whatever budgeted fixed overhead was, minus applied fixed overhead. Okay. So what is this applied fixed overhead? You will be calculating the fixed overhead per unit and you will be applying it on the standard allowed for actual production. Got it? So this is nothing but you will be adjusting fixed overhead for standard allowed for actuals. Okay. So in one word, I will tell you, budgeted is $100,000. Okay. So your budget will be $100,000. Okay. Now you will already have your standard rate for fixed overhead known. This is for 1,000 units. That means $100 per unit. Okay. Now what happens? You will calculate applied fixed overhead. How do you calculate applied fixed overhead? You produced only 600 units. For 600 units, how much capacity you are utilizing? It is only 60,000. Your actual capacity that is there is 100,000. But what you are actually using? 60,000. Okay. That means remaining 40,000 money that you are spending for this fixed cost, it is going waste. You are not utilizing your capacity 100%. This measure is known as PV variance, production volume variance. So you are purely using this only for your internal purposes. Okay. And fixed overhead production volume variance is nowhere involved with your actual fixed overhead incurred. Nowhere it is involved. You will just take budgeted fixed overhead and applied fixed overhead and you will use it in calculation. Okay. So that is why we say no connection to actually incurred costs and it is purely a capacity measure. What is the maximum capacity we are having and are we utilizing this maximum capacity or not? Then applied fixed overhead will be equal to standard rate into standard input for actual output. If it is unfavorable, that means underutilization of capacity. So one more important thing is, how do you find out whether it is favorable or unfavorable here? Okay. So whenever your budgeted data is greater than applied data, that will be unfavorable. Okay. Suppose your applied data is greater than budgeted data. That will be favorable. Now in our scenario, budget is greater than applied, which means it is unfavorable PV variance. We are underutilizing our capacity. Okay. So has everybody understood how we calculate overhead variances? Any doubts? Okay. Okay, guys. Especially for variance calculations, you will require ample practice. Make sure you're practicing as many MCQs as possible. Okay. So next up, in our variance calculations, we divide them into 4-way analysis, 3-way analysis, and 2-way analysis. Okay. So now what is this 4-way analysis? For variable overhead, we have two variances, spending variance and efficiency variance. And for fixed overhead, again, we have two sorts of variances, spending variance and PV variance. So all of them together, when you calculate, it will be a more detailed analysis. You'll get to know exactly where we are running unfavorable, where we are favorable. That is 4-way analysis, a complete detailed analysis. Suppose organization don't want to waste much of time in detailing the variances. They just want to know what is the spending variance, what is the efficiency variance, what is the PV variance. They don't want the segregation, whether spending variance of variable overhead or fixed overhead was favorable or unfavorable. They don't need it. They just need spending variance, efficiency variance, and PV variance. At that point of time, you can switch on to 3-way analysis. Spending variance directly you can find out by adding out your variable overhead spending plus fixed overhead spending. You can combine them together as spending variance. Okay. Along with this, you can calculate variable overhead efficiency variance plus PV variance. In all the ways of analysis, PV variance is common. Suppose your management is asking you, overhead variances we need not to calculate in such detail. Just tell me what is the variance I can control in the overhead and what is the PV variance. PV variance by default we will have to calculate. So your management just asks you, what is the controllable variance? How much can we control? I don't want fixed or variable segregations. What can we control? At that point of time, you will be using 2-way analysis. So here, you will be calculating total overhead flexible budget variance, which is as simple as this calculation. Variable overhead spending plus variable overhead efficiency. So now look at this. Variable overhead spending and efficiency. Directly variable overhead total variance you can calculate. No need of segregations. Then, 1 minute. Then fixed overhead spending variance. Added together, all of them are controllable variances for us. Plus our FOH, that is fixed overhead PV variance. So here, fixed overhead spending plus efficiency plus variable overhead spending added together will be our controllable variance. Okay. So wherever you find out actual data to be involved, right, that is controllable by us. And here in PV variance, actual data itself is not there. That means we are not able to control this. So PV variance separately you will calculate. So based on the requirement, we will be choosing between what analysis to be followed. Okay. So next up, we have the calculations of sales variances. Okay. So right now, starting from direct material till variable overhead and fixed overhead variances that we calculated, all of them are level 3 variances. very detailed variances that we calculated. Okay. So now the question will be, how do we calculate this level 2 variance? Okay. Level 2 variance, what are the variances we had? Flexible budget variance and sales volume variance. Okay. So calculation of them is very simple. So can anybody tell me what formula you guys use for calculating flexible budget variance? How do you guys calculate flexible budget variance? What is the formula for calculating flexible budget variance? It's very simple. So it is nothing but flexible budget, or you can take it as actual data minus flexible budget data. That is the variance between actual data and flexible budget data. Perfect. Very good. So next up, we have sales volume variance. So sales volume variance is the difference between our. So how do you calculate sales volume variance? So it is the difference between flexible budget data, flexible budget minus our static budget. Okay. So these two are our level 2 variances. Okay. And level 1 variance, it is very simple. So how do you calculate level 1 variance? How do you calculate static budget variance? Actual data minus static budget. Okay. And level 3 variances, we have learned them in detail. All our manufacturing input variances starting from direct material, direct labor, and manufacturing overheads. Both variable and fixed. All of them will be included. Along with this, you can include multiple input variances as well. Okay. Perfect. Okay, guys. So now we have sales price variance, selling price variance. How do we calculate this selling price variance? Actual sales revenue minus the flexible budget sales revenue. So this is a flexible budget variance that you are calculating, selling price variance. Okay. Actual sales revenue minus flexible budget sales revenue. So these formulas you will require it because mostly they will be tested. Okay. Just know the formula. Then it is called as selling price variance because we want to distinguish it from sales variances. Sales variances are different. Okay, selling price variance is a flexible budget variance for sales revenue line. So, in our income statement, starting from selling price, cost of goods sold, gross profit, operating expenses, for everything you can calculate flexible budget variances. For every line you can calculate it. Okay. Then comes sales volume variance. We learned this just now. Flexible budget amount minus the static budget amount gives us sales volume variances. And there is one more formula for calculating SVV, which is sales quantity variance plus sales mix variance. If it is for a multiple product. Then sales mix variance and sales quantity variance. So guys, mostly you can rely on VASP AM minus VASP SM into AQ. Okay. And for quantity variance as well, it will be actual quantity minus standard quantity into VASP SM. So those formulas you can use. Okay. So these are additional formulas which you can know about. Okay, so for mix variances, you can use actual mix percentage VAS AM minus budgeted mix percentage VAS SM into total actual units that we produced multiplied with budgeted contribution margin per unit. Okay, so then for sales quantity variances, actual total units minus budgeted total units into budgeted mix. That is, these two are indicating VAS SM. Okay. So if you don't want to complicate it so much, you can just go by this formula. For mix variance, VAS AM minus VAS SM into AQ. For quantity variance, it is AQ minus SQ into VAS SM. That will be simple. Okay. So next up, the sales quantity variance. It is further divided into market size variance and market share variance. Okay. So these two, they will not be tested much. You just need to understand them. Okay. So now, what is about the market size variance? Variance in the contribution margin caused by the actual market size being different from expected market size. So what is the size? The units that you were able to sell in the market. Actual units that you sold is different than the expected units to be sold. So that will be our market size variance. Followed by size variance is our share variance. So it is the variance in contribution margin that is caused by actual market share percentage. So yesterday we learnt about what is meant by this market share. Market share is nothing but cash generation. Okay. Market growth is nothing but the cash that we are expending. Okay. So growth is involved with cash expenditures and share is involved with cash generation. So here also, what is the cash you are generating from the market? That you will calculate in market share variance. You just need to know that. Okay. So these are the variances that we are supposed to calculate. Okay. So next up, we have the concept of responsibility centers and transfer pricing. So we'll take a break for 15 minutes and we'll be starting again from 5:45. So guys, before that, I hope all of you are clear with all the variance calculations that we discussed. Okay. If you have any doubts, you can clarify right now. Else you can show me a thumbs up. Perfect. Okay, guys. So we'll come back after a break of 15 minutes. Hello students, are you all back? Shall we start? Okay. So next up we have about the responsibility centers and transfer pricing. So what are these responsibility centers? So responsibility centers can be our departments or our units or the branches or product lines. Anything can be called as a responsibility center if you are able to measure that particular division or department in monetary terms. Okay. Now, to put it up in simple words, in an organization, all of its department, all of its units, all of its product lines, and all of its branches, they will be the responsibility centers. They will be one among these four responsibility centers. So first up, we have cost center. So this cost center, the departments that are classified as cost centers, they will be responsible only for costs, only for incurring the costs, and they will look into how they can reduce these costs in the future days. Okay. So the example for cost center can be our maintenance department, it can be our purchasing department, our production department. So the departments that only focus on cost, they will be classified as cost centers. Okay. And here, the key evaluation criteria that we use will be efficiency. Okay. So what is efficiency? We'll be looking into how we can reduce the costs. Okay. How can we become more and more efficient by reducing cost? And among the four responsibility centers, the least complex one will be cost center. Why it is the least complex? It has very less responsibility, which is to manage only the costs. And in the future days, we will be moving on towards reducing our costs without compromising the quality. That is only the focus in cost center. Then next up, we have the revenue center. So revenue center is responsible for revenue only, for generating revenue or income. Okay. And here the best example for revenue center will be our sales department, where we focus only on revenue. And here the key evaluation will be effectiveness. So what is this effectiveness? I'll give you one example. Okay. So sales is involved with this accounts receivable. Okay. Whenever you sell goods on credit, you will have this asset called as accounts receivable. So how effective you are in collecting this accounts receivable, effectiveness in the sense, timely manner. You should complete your task in a timely way. How timely you are in collecting back the accounts receivable. You have to collect it as quickly as possible. That is effectiveness. Okay. So in sales department or in the revenue center, the key evaluation criteria will be effectiveness. How quickly are we able to collect our accounts receivable back? How timely are we delivering our products? Okay. Then comes profit center. So profit center, how do you calculate profit? It will be revenue minus costs. So in profit center, the responsibility will be both for our revenue and cost. Okay. So here, the best example that we can take for a profit center will be the department or product line. Okay. So what is this department or product line? So yesterday, I think we took an example of trends. Trends is one of the product line for Reliance. Okay. So the manager who manages this trends product line. So this manager, they will have to make sure that their revenue in trends is greater than the costs. Only then they can earn the profit. So this manager is assuming the responsibility of both cost and revenue. That is why they become the profit center. That means they are responsible for both revenue and costs. Next up, the key evaluation. So key evaluation, as you are involving revenue and cost, you will have to measure them both in terms of efficiency and effectiveness. Okay. And here effectiveness is prioritized. You have to collect money as soon as possible. You have to complete your tasks in a timely manner. Then at the end, we have investment center. Okay. So this investment center, they're responsible for everything, cost, revenue, profit, everything. So these investment centers, they perform on their own. They perform all their duties by themselves. They don't depend on any other departments. Okay. So here, a complete branch office you can consider as an investment center. So the same Reliance example, they have many branches in many areas. Okay. One branch can be called as an investment center. Why? That branch, they will look after all their costs, revenues, and profits by themselves. Finally, they will report the end profit value to the main parent company. Okay. So that branch or branch office, we can call it as an investment center. Here, the key evaluation criteria will be actually being specific. It will be return on investment. Okay. And return on investment is an effective, it's a criteria effective. So these are the 4 responsibility centers. Okay. And here the important points that you need to remember is the least complex responsibility center will be cost center, and the most complex will be investment center. Okay. And the autonomous one, autonomous in the sense, if there is a responsibility center that has its own independence of performance, that will be investment center, because they perform all of their costs, all of their activities on their own. Cost, revenue, profit, everything they manage for themselves. Okay. So next up, what is common cost and how do we allocate it? Okay. So let me give you an example. We'll take the same Reliance company as an example. So we know that Reliance has its existence across different places. It is distributed into many places. Okay. And the parent company of Reliance will have its CEO, Chief Executive Officer. So what is the responsibility of the CEO? They will look after whether every branch is performing well or not. So what is the status of all the branches? They will look into the performance of all the branches. Okay. So this CEO, for the CEO, we will have to pay a salary. How do we pay them salary? We will have to record the costs, right? We will have to divide this costs for all the branches so that we will accumulate all their profits together and we will pay the CEO his salary. Now, when you look at it carefully, none of the branches directly associated with CEO's salary. Okay. So when do you call a cost to be directly included for a particular department is if they are responsible for incurring it. Okay. Let us take an example of production department. For production department, you can say direct material, direct labor, manufacturing overhead are costs that they directly influence on. Okay. If there is any variances in DM, DL or MOH, directly you can ask the production manager because that person has complete hold on them. Okay. Now, when it comes to CEO's salary, you can't go and ask a production manager why CEO's salary is increased. Can you reduce it? You can't ask because they don't have any power over it. Okay. So that cost for which none of the branch officers have a power to. None of the branch office has the power to reduce or increase CEO's salary. They don't have control over that. So such type of cost, which is common for everybody, every department in the organization, but they don't have control over them. Such costs, we call it as a common cost. Okay. And the best example will be CEO's salary, CFO's salary, or any C-suite officer's salary. You can take it as an example. Okay. Now, but this common cost, I can agree that none of the department are responsible for this. I can't ask sales manager or production manager, purchase manager to reduce or increase or influence the CEO's salary. That is acceptable. But at the end of the day, CEO is a person who is working for the welfare of this organization. That means working for welfare of all the departments. You will somehow have to pay him, right? So there are 2 methods in which we will just distribute the CEO's salary throughout all the departments of the organization. So there are 2 methods, standalone method and incremental method. Okay. So in standalone method, how do we divide it? Here, each user considers themselves as a separate entity. Okay. Now, CEO, they will allocate their time. They will spend some time in development of a particular department. Based on what time a CEO has spent in development of a particular department, in improvising a particular department, how much time they have spent there. That could be one of the criteria in allocating. Okay, let us assume there are two departments. Okay, here CEO is spending 30% of their time in the welfare of Department A, and Department A should bear 30% of CEO's salary. You can choose any of the criteria here. One of the criteria is based on what amount of time CEO is spending for the development and welfare. This is one criteria. Another criteria can be the costs incurred, or another criteria can be based on revenue generated. So based on a specific criteria, we will be allocating this cost. That is standalone method. Here for simple example, I have taken the time of CEO that is spent for each department. Based on the time spent, that department will have to compensate for the salary. So this is how we allocate in standalone method. Now, coming back to our incremental method. So here in incremental method, what happens is, assume we are starting Reliance Industry. We have started Reliance Industry only in the previous year, in 2025. Last year itself, we started Reliance Industry. Okay. And as we start, CEO was already present in Reliance Industries. So our profits and our performance was very much proper, and we excelled in the markets. For that, in 2026, I started one more branch of Reliance. Okay. So right now, there are two branches. Now, earlier in 2025, we were just a startup, and I used to pay a CEO the salary of, let us say, somewhere around 1 lakh. Okay. Now, CEO is demanding more because he has additional responsibility of managing one more branch, right? I started new branch in 2026. Now, CEO's task is increasing and he is demanding more salary. He asked me, you have to pay me 1,50,000 in 2026 because I have to manage two branches from now on. Okay. Now, as a board of director or as the owner of the company, what will I do? I will have to allocate this common cost to two branches now, isn't it? So, the primary branch, that is the first branch I opened in 2025. Already that branch was incurring the CEO's cost of 1 lakh. I will say, so that branch, let it give 1 lakh itself. As and how they have been doing, let them give 1 lakh rupees. What about this new branch that started? Because of that new branch only, I have to pay 1,50,000 to CEO as a salary. This extra 50,000, I will allocate it to branch B. Okay. So in this incremental method, what happens is, whatever departments were primarily there, whatever departments were primarily taking the benefits, they will assume the larger chunk of the common cost. And remaining or additional common cost, you will allocate it for the additional departments. Okay. Here, the largest unit that is taking the cost will be called as the primary party. Okay. And this primary party bears cost as if sole user. The example I told you. For the primary branch, I will allocate 1 lakh. For the additional branch, I will allocate 50,000. Like that. Okay. So remaining cost will be allocated to the incremental parties. So here an example. Common cost is $100,000. Primary department you are choosing as sales department. Okay. You will allocate the maximum of this cost to them. 80,000 you will allocate for them. Remaining 20,000, it will be shared by other departments. Okay. So in standalone method, equally you will distribute. According to the best measure, you will distribute the common cost properly for all the departments based on the benefits they got. And in incremental method, what happens? The department that was primarily present, it will keep on assuming the larger chunk of the common cost. And additional units, additional departments, they will assume additional charges. That is what happens in incremental method. So now, what about this contribution margin statement? Okay. Now we came to know that managers are able to control some costs. but not all the costs of the organization. Okay. And in any given department, there are two requirements. You should measure the performance of the manager, how he or she is performing, because you need to pay them incentives. Generally, this is there in every organization. Based on their performance, they will get incentives. So to give incentives, you should measure their performance, right? That is first requirement. Second requirement is what is the performance of the department or the segment. These two things we need to measure. So how do we measure that? It is through contribution margin statement. Okay. There are four main levels of contribution margin statement. So first we will be calculating manufacturing contribution margin. So how do we calculate this? Net revenue minus variable manufacturing costs gives us manufacturing contribution margin. Then further, from manufacturing contribution margin, subtract all your variable non-manufacturing costs. It gives you contribution margin for the department. Then in this contribution margin, when you subtract controllable fixed costs. Now, what are these controllable fixed costs? It is nothing but the fixed manufacturing overhead. Okay. So some part of the fixed manufacturing overhead, you will be able to control as a production manager. So that cost you will be subtracting from contribution margin. That gives us controllable margin. Okay. This controllable margin, it's very important. This is what you use for measuring your manager's performance. Controllable margin you will use for measuring manager's performance. Okay. And this is the third level of margin calculation. In 4 levels, third level is what you use for manager's evaluation. Then comes the last one, segment margin. So segment margin is controllable margin, whatever costs are directly controllable by the manager, minus non-controllable but traceable fixed costs. So now what is this non-controllable but traceable? Let me give you an example of depreciation. Okay. Now when it comes to depreciation, just a minute. Yeah. When it comes to depreciation, manager can't control depreciation, but you can allocate it. You can trace it for the department. Okay. So that is called as the non-controllable but traceable fixed costs. Best example will be depreciation. No manager can control it, but you can trace it. Okay. So controllable margin minus non-controllable traceable fixed costs will give us segment margin. So now for manager's performance evaluation, you will use controllable margin. For department's performance evaluation, you will be using segment margin. Okay. Now in our contribution margin statement, where do we get this common costs? It will be subtracted from segment margin. Once you subtract the common costs, you will be directly arriving at operating income. Okay. So this is the concept of allocating the common costs. So next up, we have an important concept, which is transfer pricing. Okay. So what is this transfer pricing in the sense? Usually what happens is within the departments, based on the type of the department. So let us take, for example, if it is a computer manufacturing company, okay, for their own administrative purposes, they will need some computer systems. Okay, so instead of purchasing computer systems from outsiders, what they will plan is, anyhow, we are the computer manufacturers. For administration, we need 1 or 2 computers. Let us request it from our production department to sell it for us. Okay, so when you require the organization's very own products, organizations departments are requiring organization's products for usage. At that point of time, you will have to transfer your products within the departments, within the organization itself. You are not selling for any outsiders. Within your company itself, you are using your own products. You have to transfer it for some other departments which need the products. Okay. At that point of time, you will be calculating the transfer price. So transfer price is the price charged by one subunit to another for an intermediate product or service within the same organization. In our example, I needed computer systems and I'm taking it from the production department. So during these types of internal transfers of products or services, you will be using transfer price for calculation. So now we are selling and receiving the products within the organization itself, right? Why do we need to calculate a charge for it? Anyhow, it is our own company. Why is there a need for pricing? This is a common question which we get. So whenever it comes to companies, each and every department, based on their performance in their department, based on how they improved their department, they will be evaluated and their incentives will be based on that. Okay. Now, in this transfer, I involved two departments, the production department and administrative department. Okay. So now, if production department and this thing is common, every department, definitely they will be measured based on their department's performance and their salary remuneration will be based on that. Suppose your production department is agreeing to give the administrative department computers for free. At that time, what happens, production department's performance will come down and administrative department's cost is coming down because they didn't purchase any computers. Simply they are taking from production department. Now, what happens? Production department manager will be demotivated because his incentives are reducing. He didn't collect anything from the administrative department for transferring computers, for giving them computers. So production manager's performance is impacted. Their department's performance is impacted. While administrative department, they are enjoying the benefits. They have reduced the cost of purchasing the computers. So now there is some inequalities in department measurement. That is why, even though it is within the company, in order to ensure that departments are competitive enough inside the company, they're not taking anything for granted. They are competitive enough. To ensure that, you need transfer pricing. Okay. Now, based on whether so there are two things that we need to focus on here. Whether the departments have excess capacity or deficit capacity. So what is this excess capacity or deficit capacity? Now, we'll take the same computer manufacturing example. I have the capacity for manufacturing 1000 computers in 1 year. That is my maximum capacity. That's the highest level of computer manufacturing I can reach in 1 year. Okay. Now, if I'm manufacturing 1000 computers and selling all the manufactured computers in the market. So guys, now tell me whether I have excess capacity or deficit capacity, whether I am performing at capacity or do I have any extra capacity left? So highest number of computers that we can produce is 1000. Okay. Now what am I doing? I'm producing as a production department. I'm producing these 1000 units of computer and all of them are sold in market. So whether we are at capacity or do we have excess capacity? Okay, Navya. What about remaining students? Yes, it is at capacity because maximum computers I can manufacture is 1000 and I'm already manufacturing these 1000 computers and all of them I can sell it in the market. That means I am performing at capacity. I don't have any idle time at all. I'm fully equipped with work. Okay. Then there is one more concept called as having excess capacity. That means I can manufacture 1000 computers. But as of today, I'm manufacturing only 800 computers. I still have the capacity for manufacturing 200 more units. That is my excess capacity. Okay. Now, based on how busy our production department is, they will be fixing the prices. Okay. If production department is completely equipped, they are producing 1000 units, they are selling 1000 units, and they have no idle time left. Okay. And remember this thing, every manager, based on their performance, they will be evaluated. Production department also, they will be evaluated, right? Never do they want to reduce the profits. So they will be okay with the price, that is market price. So now we will look into various prices that one department can cost for the other while maintaining both of their profitability. So now it's a kind of competition itself between the departments of the company, who is more profitable and who is not. There will be such kind of a healthy competition between them. Now let us go through the methods. First up, we have market price. Okay, so when does this happen? Best when external market exists, objective and arm's length, and it is used when division is at capacity. That means the division doesn't have any idle time. All the units that they produce, it can be sold completely. Okay. Now think like the manager, think like the production manager. Okay. You will have to look for your department's profits first. Okay. So now if you want to transfer any goods for other department, you will be agreeing only for market price. Okay. Not any price less than that. Why? Because if we are not transferring any goods for other department, whichever has requested, administrative department, let us assume, I already have external market where I can still sell all my products and make profits. I don't want to lose my profitability. That is what happens. So market price is chosen when department is performing is at its capacity. It is fully equipped. No idle time is left. Then next variant is cost plus opportunity cost. Okay. So what is this opportunity cost? Cost of choosing the next best, the cost foregone for not choosing the next best alternative. Okay. So what is this opportunity cost? Think like the production department manager. Okay. You already have a market price at which you can sell all of your products to external customers. Suppose another department is coming and asking you to sell some of your products to them. What will you say? So my opportunity cost is I am having external market to sell all my products. Okay. If I sell those products to you, I'm losing my profits. That is my opportunity cost for selling goods to you by stopping my sales to external customers. If you agree to give me the profits that I lost for not selling to external customers, I will be selling goods to you. This is what the conversation happens between production department and the other department. Okay. Opportunity cost for the production department right now is the profit that they lost for not selling their products to external customers. If the other department is able to compensate for this profit, they will be agreeing to sell the products to them. So this type of costing or transfer pricing is called as cost plus opportunity cost. Outlay cost plus profit given up by selling internally, which will be very close to the market price. Okay. So next up, we have variable cost. Now, assume our production department, we are having so much idle time. Okay. So our capacity is 1000 units manufacturing. But right now we are manufacturing only 800 units. 200 units more capacity is there with me. Now we can't bargain because already we have idle time. So what will administrative department tell us? They will say us, already you have excess capacity. Why don't you use it for organization's benefit? So we want you to manufacture computer and give it to us. I will not pay you market price and all because you have excess capacity already. I will just give you your cost of production. That is only variable cost that you have incurred till now because that is the only extra cost that you are incurring for producing. Okay. So at this point of time, when we have excess capacity, we can't bargain anything with the administrative department. They are right on their side. Anyhow, we are sitting idle. We can produce computers for organization's benefit. and the only extra cost we are incurring is variable cost. That is direct material, direct labor plus variable manufacturing overhead. Now you can get a doubt. What about this fixed manufacturing overhead? Okay. So now fixed manufacturing overhead you are not supposed to cost for the administrative department. You know why? Because fixed manufacturing cost, I'll give you one example. If you buy a house on rent, if you stay in the house or if you don't stay in the house, you have to pay 10,000. Same concept. If you had accepted the order from administrative department or not, your fixed cost you will have to pay. Got it? That is why fixed cost you should not charge it to the other department when we have so much idle capacity left. At that time, the only cost we are able to charge is variable cost. Direct material, direct labor plus variable manufacturing overhead. Got it? That is variable cost. And when we have excess capacity, we will be choosing this. Moving on to the full cost. So in full cost, what happens? Here, all material, labor, full overhead allocation. That is both variable manufacturing overhead and fixed manufacturing overhead. So here what happens is, production department, if they have excess capacity and the administrative department is saying them that it's okay, you need not charge variable cost only, I will pay you full cost, including fixed manufacturing overhead, I will pay it for you. This is what administrative department is saying to production department who already has idle capacity. Okay, at this point of time, for production department, it is profit. It's a profit to them. You know why? Fixed manufacturing overhead that they are receiving, right? That is their profit. When it is for full cost, if they ask you if a department is getting paid in full cost, instead of having excess capacity, at that time, their profit will be equal to fixed manufacturing overhead. Okay, because this fixed manufacturing overhead, it is not dependent on the units that we are producing. Already we have paid fixed manufacturing overhead. And again, when we collect it from the other department, it's an extra profit for us. Okay, and one thing, fix it in your mind. If you have the idle capacity, and if you are charging the other department anything greater than variable cost, you are in a profit position. Okay. Then the fifth method which we have is cost plus. So this cost plus, it will be at the discretion of both the departments. They can choose it. Variable cost plus fixed cost plus markup. Cost plus says that whatever cost of production you are incurring, the entire cost of production. Along with that, you can add any markup percentages according to your requirements. Okay, so this cost plus, it should be agreed upon by both the departments entering into this transfer pricing. So that is the fifth method. Then we have sixth method, which is negotiated price. So what happens in this negotiated price? Now, production department is at its capacity. Okay, and administrative department, this is a scenario where if they purchase from outside, they will have to pay somewhere around 10,000, assume. But production department, which is working at its capacity, it is asking for them to pay 12,000. Okay. Now, for production department will not agree for any amount less than 12,000 because they have active market. And administrative department is not agreeing because if they purchase from outsiders only, they will pay 10,000. But this production department is asking them 12,000. So now there will be a serious negotiation between production department and administrative department. Now what happens? Both of them will negotiate such that both of them are in a profitable position. Okay. Now, senior management will take a final call. They will say production department is asking 12,000 and administrative department is asking 10,000. We'll fix a price in between these two. They'll fix it for 11,000. Okay. Such that both of them are getting profit. That is negotiated price. Then arbitrary pricing. So when do we choose arbitrary pricing? When we don't have a clarity what type of price we can include. At that point of time, price will be set by central management. They will say, we will give you transfer price. Based on that itself, all the transactions should move on. Okay. Then we have dual rate pricing. So in this dual rate pricing, what happens is, So in times of serious negotiation between two departments and both of them are not agreeing to each other, at that point of time, final call which senior management can take is dual rate pricing. They will say them, okay, so production department can maintain their records in market price, because production department we are evaluating based on their profitability, right? That's why. Then the buyer administrative department can record it at their variable cost. Here, if you look at it carefully, both of them are satisfied. And the price at which they are recording in the records, right? Both of the prices are different. Now you can ask me, how it can be? How can both departments maintain at different prices? At the end of the day, both the departments belong to the same company. Just to satisfy both the department managers, this call will be taken by senior management. Okay, at the end of the day, company is not losing anything, it is not gaining anything. So in extreme situations, dual rate pricing can be chosen. So among all these methods, the mostly tested one will be market price, cost plus opportunity cost. Sometimes it will be tested, variable cost and full cost. Okay, and in theory, you can expect negotiated price. Yeah, so these are the mostly tested areas. So then, what is this multinational transfer price? Okay, so what used to happen is, if I have a division in India and US, the tax, okay, we'll take India and Dubai. We know that tax rates in Dubai are very flexible when compared to tax rates in India. So now, as I have two companies in two different countries, I will plan to take the advantage of this tax benefit by altering my transfer price accordingly. So this is just like earning free money without any work. Just by altering transfer price, I am earning money. So this is illegal. You know what happens if I have to transfer any goods within departments across the countries? Then I have to choose the market price by default. That is the rule. Okay. So multinational transfer prices have to occur at market price, because we should not give this liberty for the companies to make use of this tax differences. That's illegal. Okay. So multinational transfer prices occur at a market price, such that it's nowhere different from selling your goods to third parties. At that price itself, you have to transfer if it is between one country and another country. Okay. So now let us look into the objectives of transfer pricing. It is goal congruence. Goal congruence in the sense, if you have a look at all the methods that we looked into, everywhere we are trying to satisfy both the department managers. Okay, that is goal congruence. Then autonomy. Autonomy in the sense, we are giving this liberty initially to the department managers to choose the best price they want to. That autonomy is there. Then comes motivation. So here, all the departments are motivated because they want to enhance their profitability, and there will be a healthy competition among them. Then comes organizational fit. So transfer pricing should align with the culture, with the structure and legal or regulatory requirements, as the one we saw in multinational transfer price. Okay, and capacity rule. At full capacity means external market is there. At that time, the best price you can use is market price. If you have excess capacity still left, you can use variable cost. Okay. Selecting the right method. How can we select the right transfer price? It depends on the company's goals. It depends on producing division's capacity. If they have full capacity utilized, market price is only what you need to choose. So it depends on capacity. Then legal and regulatory requirements. Okay. So these are the things we need to know in transfer pricing. Next up, ROI and RI calculations. Okay. So now, what is this return on investment and residual income? Okay. So it's a simple concept that if you invest 1 lakh rupees, you want something more than that in return. Okay. So what extent of return you are getting on the capital invested? That is return on investment. Okay. Now, how do we calculate return on investment? Operating income divided by invested capital. That is total assets employed. So this is how we calculate return on investment. What is the operating income we have generated divided by what is the total capital I invested. So that is my return on investment. So you can also use the other formula, which is, you can look at this, operating income divided by revenue into revenue divided by assets. Okay. So you just need to have a glance at this. No need of memorizing. We call this as DuPont formula. Okay. Return on assets into asset turnover will also give you return on investment. Yes. Now, required rate of return. So what is this required rate of return? I need a minimum returns on whatever investment I make. Okay. Suppose I invest 1000 in stock market. I am an investor who wants a minimum return of 10%. If I don't get 10% return, I don't want to invest there. That is what is meant by hurdle rate. The minimum rate that we want to earn from a investment to justify our investment. Okay. So usually it can be companies' weighted average cost of capital. Weighted average cost of capital means what? So when you want to raise capital from external parties, it can be your debenture holders or it can be your equity shareholders. You want to pay them something. Free money nobody gives. For debenture holders, you will have to pay interest. For equity shareholders, you will have to pay dividends. That is your cost of raising capital. Usually, for the companies, it will be weighted average cost of capital, that will be their hurdle rate or required rate of return. Now, what is the use of this ROI? You can use it as an evaluation tool. Okay. You can compare between the units and the company overall. You can see which department is performing well and which is not. Then decision tool. If you are offered a project, you will obviously choose a project that has maximum ROI. For that, you will choose a project that has maximum returns. For return calculation, you need ROI. Then comparing against the company's cost of capital, ROI will be useful for us. Okay. Then what are the benefits and limitations of ROI? So first up, ROI. If you look at it, it's a very simple formula. Operating income divided by invested capital. So it is easily understood, widely used and easily calculated also. Then comparable across units. Okay. As you are representing it in percentage, you can compare it across organizations of different sizes also. Okay. Why different sizes also we can compare in the sense, you are calculating the return on investment. So it can be any amount of operating income. If it is for a sole proprietorship, who will have small income, let us say somewhere around 10,000 on their invested capital of 1 lakh. So somewhere around 10% returns. You can calculate that. So 10% ROI from a sole proprietor. Again, you can compare it with Infosys performance also. Infosys will have operating income of somewhere around, let's assume, 1.2 million divided by invested capital 12 million. Assume. So against ROI of Infosys, you can easily compare sole proprietorship irrespective of their size because you are representing in percentage. Got it? That's one of the benefits. Then it can be compared to the cost of capital, required rate of return. Suppose your ROI is 15% and your expected required rate of return was 10%. You can easily compare, right? You can choose the project because it is more than your required rate. So for comparisons, you can use it. Then comes limitations. It is measuring only percentage, not the exact monetary amount. Then managers, if they are evaluated based on return on investment, a lot of chances that they might reject the projects that can be useful in the future. So why does this happen? Let us take an example. So if a company has a acceptable ROI means, let us say if it is 12%, that's an indication to manager that he can choose any project which is greater than 12% ROI, any project. Okay. Right now, assume you are a manager. Right now you have a project of 20% ROI and that is ending in this year itself. It doesn't have any future. That's a very traditional project. It doesn't have future prospects itself. And I am giving you one more option, okay, which is 15% ROI. 15% ROI, but for next 10 years, you can take the benefits from this project. And now, when I give you incentives based on ROI that you have generated, you will not be willing to choose that 10 years useful project with an ROI of 15%, because this year you already have a project with ROI of 20%. So, managers will easily reject profitable projects by just looking at ROI. Highest ROI they will choose. Irrespective of whether that project has a future or not, they will just choose projects with highest ROI. That is not good for the organization. It might give managers their incentives, but it is not good for the organization. That is one of the limitations. Then it is short-term bias over long-term profits. The example that we came across now. Then distorted by accounting policies. We'll look into how accounting policies are distorting ROI. We'll look into it. Okay, so this is about ROI, return on investment. Then next up, we have residual income. So what happens in residual income? In residual income, what happens is, assume I have invested 10,000 in stock markets. Okay, and I want 10% in return. Okay, 10% of 10,000 is 1,000 rupees. That is what I am expecting, 1,000. Okay, so if I get any project that is giving me profits of greater than 1,000, I will easily accept it, because my required income was 1,000 on my investment. And here is a project which is paying me more than 1,000, more than what I need. So obviously I will accept it, right? That is the concept of residual income. Okay, so operating income is what we actually get from the project minus your invested capital multiplied with your required rate of return. 10,000 multiplied with 10%, which is 1,000. If your operating income is anything greater than 1,000, easily you will accept that project. So if any projects for that matter, if they have positive residual income, easily you can accept it. Directly you can accept those projects. When it comes to return on investment, if return on investment is greater than your required rate of return, then you can accept those projects. Okay, this is the criteria which we take. So next up, how do we compare ROI and RI? Okay, ROI is calculated as operating income divided by invested capital. Here, operating income minus assets, that is invested capital only, into hurdle rate or required rate of return. Okay, so now look at this. Both the measures, they will be impacted by any changes in operating income and any changes in invested capital or required rate of return. Okay, then here we are measuring in percentage. Here we measure in monetary returns. And ROI, short-term bias is there. Managers will blindfoldedly, they will choose ROI, which is maximum, without thinking about future. But here, as we accept all the projects which have residual income of greater than 0, so here chances are less that we will reject the future, we will reject the projects with very good future for the company. Chances are very less in RI. Okay, here for units with different sizes, you can use ROI for comparison. I gave you an example of sole proprietorship and Infosys. Easily, they both are of different sizes, but easily you can compare them. Okay, but when it comes to residual income, if you compare the operating income of sole proprietorship, which can be 10,000, against the operating income of Infosys, which can be 1.8 million, that's meaningless. So it's difficult to compare across differently sized units. And both of the measures, ROI and RI, will be impacted by accounting policy distortions. So how are they impacted? Let us look into it. So first up, we have inventories. Okay, inventories we know. FIFO to LIFO changes during inflation. So inflation, or normally we are in an inflated economy itself. Every year, prices of goods and services have kept on increasing. Okay, now when you change from FIFO to LIFO during inflation, what happens? We'll look into it. Okay. So FIFO is nothing but first in, first out. And in ending inventory, you will have the latest purchased products. Okay. And in the cost of goods sold, you will have earliest purchased products. Exactly opposite in LIFO, last in, first out. So latest purchased inventory will be sold first. Earliest purchased inventory will be retained in inventory. Okay. This is what happens. So now what happens during inflation? Under FIFO method, you will have lower COGS because you are selling products that you have purchased before, which has lower price. Okay. And as your COGS is less, it will give you higher operating income. Okay. And then what inventory do you have in FIFO? Latest purchased goods which have highest price. That goods you have in your inventory, which means higher operating income and higher inventory. So your ROI and RI calculations will also be very high if you use FIFO. Okay. Now suppose you are using LIFO. In LIFO, in your ending inventory, you have earliest purchased goods, which in the inflated economy, they will have less price itself. So your ending inventory value is less. Now, what happens with cost of goods sold? Recently purchased goods you are selling, which means cost of goods sold will be high. Okay. And if cost of goods sold is high, your operating income will be reduced. So in LIFO, you will have lower income and lower inventory. And obviously, your ROI and RI will be lower. Okay. So why do we have to think about this accounting policy changes in inventory? Okay. Suppose you have to make a decision on a particular project, or you have to compare the performance of the divisions. If they are using different inventory valuation methods, then your ROI and RI evaluations and comparisons will be meaningless. If a company which is using FIFO is compared with the ROI of a company which is using LIFO, that doesn't give us meaningful results. Okay, that is accounting policy distortion when it comes to inventory. Then depreciation method. So depreciation, we know old assets, obviously they will have low market value, low book value on the balance sheet. New assets, they will be having higher book value in balance sheet. So on the assets, we calculate depreciation, isn't it? So when you calculate depreciation on old assets, depreciation expense will be lower because old asset value in balance sheet is lower. So when it is lower depreciation, your operating income will be higher. Got it? When it comes to new asset, if you calculate depreciation on new asset, depreciation expense is higher, and that will further reduce your operating income. Okay. So technically look at this. If you are using old assets in your organization, it's not a value adding thing for you. You don't know when that asset will be depleted, when you will have to sell that old asset. You don't know. That is not a value adding factor for your company. But if you calculate ROI and RI for the company that has old asset, just because depreciation is lower, you will get higher ROI and RI, which is a false measure. By looking at higher ROI and RI, I will assume that division is performing very well. But this is the case. They are using old asset, which I don't know when it will stop being utilized. Okay. So that is again a accounting policy distortion. Then moving on, asset capitalization policy. So asset capitalization policy, it will be different when compared to different companies. A sole proprietor may capitalize an asset they purchase for 10,000 because that's a valuable amount for them. Assume another company. Okay. Let's take Infosys. Do you think if they purchase anything for 10,000, they will capitalize? Obviously not. That is not a capital amount for them. That's a very insignificant amount for them. So now capitalization policy, how it works? Infosys will not capitalize this 10,000. They'll just expense it in their operating income, and it will reduce their operating income. But sole proprietor, they will capitalize this 10,000 rupees of asset. So that will be added to assets. Understanding? So here what happens for a sole proprietor, asset value is increasing. And for Infosys, operating income is reducing because they expense the 10,000 purchase completely. So now for one company, operating income is more. And for the other company, asset value is more. Both of them, for the same asset, they have different capitalization policy. Again here, ROI and RI will give us conflicting results. They both we can't use for comparing these two organizations with different asset capitalization policy. Now, when it comes to absorption costing, okay, which we will be discussing in section D. So here, what happens in absorption costing? So there is a rule that whenever your production is greater than sales, if you produce more units than you are selling, your inventory value in absorption costing will be more. Okay. So now, if inventory levels rise, what happens to operating income? If inventory levels are rising, inventory and cost of goods sold, both of them are opposite to each other. If inventory is increasing, COGS will reduce and vice versa. Okay. Now what happens? Operating income will increase because when inventory level is increasing, COGS will reduce obviously. So operating income will increase just because you are altering your production and sales plan. This is happening. Okay. Again, this will lead to accounting policy distortion. Then at the end, we have this position of manufacturing overhead variances. This also we will cover in section D. No need to worry. We'll cover it in detail. So here what happens? We will have two choices. You can close your variances. Variance is what? Difference between actuals and fixed, actuals and budgeted. So you can close it out into COGS or you can divide it equally among inventories and COGS. Okay. So based on the disposition method you are choosing, again, it will vary our ROI and RI. Okay. So anywhere you find changes to your cost of goods sold or inventories or operating income, that will have significant influence on your ROI and RI. Okay. So now based on the method of disposition that you're choosing, either to close it completely into COGS or to prorate it equally among COGS and inventory, that will impact ROI and RI calculations. Okay. So everybody is clear with ROI and RI calculations? Any doubts? Yes or no? Okay. So 1 out of 6 students is clear. What about remaining students? Clear, guys? Yes. Perfect. Next up, we have balance scorecard analysis. So what is this balance scorecard analysis? Now, suppose we are in a leadership position. I am a manager of a company. Okay. So if I am evaluated solely based on my financial performance, as a manager, what will I think? If I just increase profits for the department, I will get my incentives. So I can choose any legal or illegal way, ethical or unethical way for achieving profits if I'm solely evaluated on financial performance. So what does the company do now? What they will do is they'll conduct a 100% or 360-degree evaluation for a particular department. Okay, 360-degree evaluation in the sense they will not only include financial measures, they will include ethical measures, legal measures, qualitative measures, all what is required for understanding completely the performance of the department. Because Earning profits is important, but not in an illegal way. To check on that, there is a 360-degree evaluation conducted, which is known as balanced scorecard. Okay. So, what is this balanced scorecard? Balanced scorecard transforms the strategic plan into day-to-day marching orders, combining both financial and non-financial measures. So, balanced scorecard is combining both the financial and non-financial measures in order to ensure this 360-degree evaluation. Okay, because if you just choose financial, there are a lot of loopholes which will cause trouble for your organization. Okay, so here, if you observe carefully, financial indicators are told as lagging indicators and non-financial indicators are told as leading indicators. What does that mean? Financial indicators will be your gross profit or net profit calculations. Okay, that will just help you calculate your profits for this year or next year. It's a short-term motive. You will calculate what will be your profits this year, next year. That is all what you do. When it comes to non-financial measures, that is, when it comes to your strategy, when it comes to your customer relationship, when it comes to your stakeholder relationship, if you have strong corporate relationships with all of them, and if you have very talented employees, that's a very good qualitative factor for your company. And that will help your company on a long run, not only this year, forever until this company exists. It will help you. That is why it is a leading measure, and financial measures are lagging measures. Now, how do we understand this balanced scorecard? It is from learning and growth way till financial. Got it? So, first important thing in balanced scorecard is what type of business model we are following. Okay, what is this business model? I'll give you an example. Some restaurants, their business model is to offer tasty food to the customers without compromising on the taste. But when you look at the interiors of the restaurant, it will be decent, not so much luxurious, not so much decorative. But when you taste the food there, it will be very reasonable and satisfactory. This is one type of business model for hotels. There is another type of business model where they focus more on the decoration of the restaurants. They'll make it look more luxurious. When you taste the food, it will be of a acceptable, decent quality. Not so, not such a praisable quality. Okay, these are the two types of business model. One is offering reasonable and very good food. One is focusing on making it more and more decorative to attract people. First, companies should be clear with their business models. Okay. After choosing the proper business model, they will be moving to learning and growth perspective. Here, learning and growth is the first thing. First, when we choose the business model, we should learn what are the measures, what are the processes, what type of people we need, how do we need to train them. All these things you will have to learn and grow in the first step. Got it? It involves employee training, information systems, leadership, and knowledge management. And continuously, we will have to upgrade ourselves. Okay. Next, after learning and acquiring adequate knowledge, we will be stepping up to internal process. In internal process, we will focus on improvising the processes of the firm. How to reduce defect rates of products, how to reduce our turnaround time. That is, from raw materials into sales, when we convert, that is turnaround. Okay. Then quote time, how to maximize order size. We will focus on improving the processes, on making them more and more efficient. Now, when you make your process more efficient, you are reducing the cost of the products for your customers. Got it? So, once you are clear with the internal processes, once you have made them more efficient, once your innovations are there, costs are reduced, you're more efficient. So halfway you have satisfied your customers. Okay. Now in the customer segment, you will be focusing on how well you can satisfy your customers. Already you have provided them innovative products and already you have given them products with reasonable quality. What more is required to satisfy your customers? That is what you look at in customer perspective. Then at the end, you have financial perspective. If you satisfy your customers, obviously your finance will grow. If you have more number of satisfied customers and loyal customers, obviously your profits will grow because there are more people who buy your products. That is your financial perspective. So all of them are interlinked. Good learning and growth will lead to good internal process. Good internal process leads to good customer satisfaction. Good customer satisfaction leads to a lot of profits. Okay, this is balance scorecard. Next up, what are the critical success factors? Critical success factors are those which are the reason why we generate profits. Okay, if for an example, if I have to say, Apple company, they are very well known for giving high utility smartphones and laptops, and their smartphones have very good camera quality. This is their critical success factor. People are choosing iPhones because of this critical success factor. That is the main reason Apple company is getting more customers. Okay, so that is their critical success factor. Okay, so these are specific actions an organization must perform at the highest level of excellence to achieve goals. And the key performance indicators will be measures of performance in the critical success factors essential to competitive advantage. Now we spoke about iPhone. So what they will have to focus on? They will have to focus on product uniqueness. Okay, so this product uniqueness is their critical success factor. And their key performance indicator can be how many new product features they are improvising, how many features are they including in iPhone to attract customers. This will be their key performance indicator. Okay. Next up, we have the strategy map. Strategy map is nothing but it links all the 4 balance scorecard perspectives together and it shows us a clear idea how we can follow. Then, what are the benefits and limitations of balance scorecard? So, it encourages long-term focus because we are including both financial and non-financial indicators. Okay. Then, it is rewarding non-financial indicators leads to long-term financial improvement, as we looked at in balance scorecard. Next up, what are its limitations? It is difficult to compare across units. Yeah. So balance scorecard, it is very customizable. Okay. In an organization, if there are 10 departments, all 10 departments are supposed to frame their own balance scorecard. Okay. And it will be based on their strategies, based on their viewpoints. So when balance sheets are customized for specific departments, specifically they will be customizing. So how can we compare across units using their balance scorecard? It is difficult because it's highly customized according to departments, their own perspectives. So comparison is difficult. Then balance scorecard for large scale companies, they will be requiring ERP systems for perfect implementation. Okay. Then non-financial data not subject to external audit. Yeah, this is one more thing. If we include non-financial data, financial data we can audit and find out the errors. How you will find errors in non-financial data? It is very subjective. You can't judge a qualitative data. Easily we can come to know quantitative data's correctness, or is it correct or wrong, we'll come to know. Qualitative data, how we will analyze whether it is correct or not, it is not possible. That is again a limitation. Okay. So next up, we have the concept of customer profitability analysis and product profitability analysis. So it is a simple concept. So what happens is, usually for companies, 80% of their profits, they will get it from 20% of their customers. You know why? Because these 20% of customers will be large customer groups who will place more number of orders. Okay. So if you get bulk orders at a time, that results in your economies of scale, because it saves you a lot of fixed costs. It saves you a lot of time of production. So from 20% of the large customer groups, you are getting bulk orders. So your profitability will be more. There itself, you are becoming more and more efficient because you have got bulk orders. Economies of scale is obviously there. Your cost is reducing and your profits from the customers will be more. Usually, large customer groups will be there, so they will be very loyal in making payments. Okay, so these are the reasons we say 80% of profits will come from 20% of customers, and 20% of the customers will be completely unprofitable to us. Okay, why? Because they will order, if it is a wholesale company, these 20% of customers will buy somewhere around 5 products, 15 products, they'll place orders. It's obviously a loss for the company. Okay. Now, what do we do with this profitable customers and non-profitable customers? So that is what we discuss in customer profitability analysis. Okay. So think like the owner of the owner of the business. Okay. Now what happens? Your high value customers, you will be motivated to preserve them in your company. You want more and more high value customers for you. Okay. What you will do in order to have loyal customers, loyal large scale customers, what you will do? You will give them more and more discounts to encourage them to stay within the company. Okay. And this 20% of customers, you are a wholesaler and they're giving you orders for 1 product, 2 products, 10 products. It's a loss for you. You somehow want to demotivate them. So now what you will do? You will charge more extra prices for ordering small quantities. Okay. At that time, customers will either have to pay for the small quantities, they will have to pay more for small quantities they ordered, or they will disassociate from the firm. This is how you eliminate unprofitable customers, by increasing price to them, reducing discounts. For large customer groups, you will give them more and more discounts and you will help them retain their purchases in the industry, in the company. Okay. This is what we do in customer profitability analysis. And the same thing holds good for product profitability analysis. Now let us say Reliance has so many product lines, footwear, trends, Reliance Smart, and they also have their mobile phones. So among all these product lines, somehow they have noticed that Reliance Footwear is giving them a lot of losses. So that product line is not profitable to them. So what they will do? They will take away this product line. They'll discontinue that product line. Whatever product lines are profitable, we will hold them in the company. And which is unprofitable, you will just discontinue that. That is product profitability analysis. Okay. Yes. So hence we have walked through all the important topics of section C. And these are some of the important formulas: price variance, quantity variance, total variance, MPPV, rate variance, efficiency variance. You'll have to practice all of them. And variable overhead variances, fixed overhead variances, and your controllable variance. And these are some of the formulas we discussed today. Yes. So this completes section C. Okay, guys. So now tell me, all of you are clear about all the topics, or if you have any doubts, you can ask me. All 6 of you. Perfect. Okay, guys. So your task for section C is to practice as many MCQs as possible when it comes to variance calculations. Okay. ROI and RA calculations are also important. You need to focus on them. And balance scorecard, mostly it will be theory oriented. Okay. Yes. So this is up for section C. Okay, guys. So I think we are good to end the session for the day. Yeah. So tomorrow I'll be meeting you with the section D concepts. Okay. If possible, once revise section D so that you'll get a great clarity in tomorrow's session. Okay, guys. So thank you all. We'll meet tomorrow.